All right, lesson 2, this is finding a business. So this lesson goes over how to find a business on Flippa and how to sort through the thousands of businesses that Flippa has listed to find ones that fit your investment thesis. Now, there are several ways to source your deals. And now when I say source deals, I just mean there's different ways to find different possible businesses to invest in. Now, sourcing deals is very important because the larger the sample size you have of businesses, the more likely there is to be a business that really fits your investment thesis. Now, there's different ways for doing this, right? So first you can just browse businesses using Flippa. You have all these different sorting criteria on Flippa that you can sort through. You can search by keyword, you can search by business size, lots of different filters here. So you can just use Flippa's built-in browsing tool. You can also engage a broker on Flippa to help hand select businesses for you. Now, if you engage a broker on Flippa, they'll be able to do a lot of the searching process for you, and they know these businesses already because they're the ones that are handling the listing process for the seller. So they'll have a good idea of whether or not that business fits your investment thesis. If you fill out your buyer mandate and you engage the broker, they can help bring you deals that already fit your investment thesis, so you don't have to spend all this time searching through businesses that may or may not fit your thesis. Another recommendation that I have that's completely free for you to do is to go turn on your email notifications from Flippa. They send out daily and weekly emails with all the new businesses that they list. And then finally, something that's really recommended is subscribing to First Access. Now, a lot of businesses on Flippa, especially the high quality businesses, they become available for 3 weeks to First Access subscribers. And just about 2/3 of them that end up selling, they actually sell, those 2/3 sell in the first 3 weeks. So during their first access period, and you only get access to these deals if you have First Access. So I'd really recommend subscribing to First Access and turning on email notifications. So many different ways to source the deals. Now, this lesson is primarily going to go over, once we have the deal in front of us, how to evaluate the listing head to toe to figure out a bunch of different things. Number one, if this fits our investment thesis, and if it does, whether this is a good investment, whether we're going to be able to run this business, and what to expect out of the business after we buy it. So finding and evaluating a business. All right, so first here in the general snapshot of the business, the first things that you want to do before proceeding down the listing is you want to check for a verified listing. Now, Flippa verifies listings through third parties, which means when the seller lists their business on Flippa, they have the option to integrate and connect with third-party software such as Stripe, Amazon, Shopify to verify data that the seller is telling you. Now, if this is a verified listing, you'll see little icons at the top of the listing that show you exactly what information is being pulled for that business. So that's the first thing to note. A business listed on Flippa with more verified icons just means that more of the data is not subject to error, is not subject to fabrication, right? It just means that the data is being pulled directly from those third-party softwares. Secondly, we want to look at the business overview and the analyst snapshot. So this is going to help you determine whether the business is in line with your investment thesis. So this is the first thing that we really want to look at, right? It's just an overview, high-level description of what the business does, what the business is, and then we want to move down to multiple and valuation. So every listing on Flippa has an asking price. Some will indicate that they're open to negotiation, but typically this asking price is anywhere in the range of 2x to 4x of the net income of the business. So if the business makes $100K a year, the asking price is likely on Flippa going to be listed for $200,000 to $400,000. If you're looking at a business that has a listing price anywhere outside of that 2 to 4x range, then you're probably going to have to do a little bit more digging. There probably is a reason for this, although sometimes sellers like to start their business high and they'd be open to negotiation a little bit lower. If you are looking for cash flow out of this business, which most business investors are, then a business valued between the 2x and 4x range is probably going to provide you cash flow that's on par with what you'd be looking for elsewhere in the industry. So if as part of your investment thesis, you decided that cash flow is very important to you, you probably want to make sure that the valuation is in that range somewhere, because if the valuation is much higher than the 2x to 4x range, that just means that it's going to take you over 4 years to recoup your investment if that business continues operating at the current levels. So that's a really important first thing to kind of look at, is how long is it going to take me to make my money back on this business? And the valuation compared to the monthly net profit or the yearly net profit is going to show you exactly how long that takes. So a business listed for $400,000 that makes $100K a year, obviously 4 years to recoup your investment. That's a really important piece of data that you're going to want to compare against other businesses. It's obviously not the only factor that's going to influence your decision, but it's pretty important. Now, if the multiple is above that range, the 2 to 4x range, there could be a few reasons for this. Now, the first reason for this is the seller could just be starting high and is open to negotiating a sale price, which is more realistic in the 2 to 4x range. Another reason could be that the business has some competitive advantage, making ownership worth more than just a multiple on the earnings. So the baseline way, like I said, to value a business is based on its earnings. However, there's a lot more nuance to this. If the business has some competitive edge, if the business is super unique, it could be listed for higher than that 2 to 4x multiple, but that does not warrant you just throwing the business away because you say it's too expensive. You'd want to dig into exactly why the valuation is higher. Things like this could be patents, any unique intellectual property, invaluable long-term partnerships, right? So if someone has a long-term partnership with an industry leader and maybe that partnership is exclusive, then that could be a really, really big deal in terms of solidifying that value above that 4x range. And now, no, just because the seller believes their business is unique and deserves a higher multiple, it doesn't automatically mean that the business is actually worth that amount, right? So it's on you to determine whether the justification for that valuation is valid to you or not. Now, the bottom line here is that a business is only ever worth what someone is willing to pay for it. That's the same way with any asset out there. A house is only worth what someone's willing to pay for it, right? And then the market decides collectively what everyone is willing to pay for it, and then that's what determines the value of that asset. So if someone out there is willing to pay $1 million for a business that makes 10K a year, then at the end of the day, that business is worth $1 million. And if for some reason a business is making $1 million a year and nobody's willing to pay more than 500K for it because, the market may perceive some huge risks or maybe the business is tanking, right? Then that's ultimately the value of the business. So while yes, there are guidelines to determining what a business is valued based on several factors I've just listed, at the end of the day, a business is only ever worth what somebody is willing to pay for it. Just keep that in mind. Now, a good rule of thumb here is that a seller is always going to value their business higher, and a buyer is most likely always going to make a case for a lower valuation, right? That's what creates a market. Now, even though this is the case, don't let this deter you from constructive conversations about a potential deal, right? Just because you aren't in agreement on the valuation at first, this is just how people view their own assets compared to other assets. If you've spent 5 years putting your blood, sweat, and tears into building a business, and you know that business like the back of your hand, you're probably, when you go to sell that, you're probably going to think that business is worth or valued at a higher amount than someone who just discovered this business yesterday. It's just how it works. So like I said, don't let this deter you from constructive conversations about reaching a potential middle ground and getting a deal done. Now, other significant factors that may affect the valuation of the business. Now, growth is a really, really big part of that, or decline. So the business may warrant a higher multiple if the year-over-year growth is significant. Now, when I say significant, it's probably 25% or more for at least 2 to 3 years, right? So if the business is bringing in more revenue or more profit over 2 to 3 years by 25 to 30% every year, that's a very attractive business, and it's probably going to command a higher multiple, maybe somewhere in the 3x to 5x range, than if something is just proceeding flat or even declining. Now, one key here is that you should always make sure that you understand where the growth is coming from. So if there's any significant spike in the earnings for 1 to 2 months, you should investigate why this is, right? If the earnings shoot up and then come back down, you should understand why that is. Now, all of this is going to be relevant when you're going through the business and you're evaluating the business within the Flippa listing. So if you scroll down to the financial section in the Flippa listing, you're going to be able to see a revenue and profit graph for the last 12 months for most businesses. Now, it's worth noting that the best form of growth is steady, consistent, moderate to slow growth over 12 to 24 or more months. Now, one really, really good trick that I like to use when I'm evaluating the growth of a business is that growth presents itself in more ways than just revenue growth or profit growth, right? Typically with sustainable, real growth, you're also going to see growth in core KPI metrics like traffic or social media followers or email subscribers, right? We want to make sure that all those metrics, all the core metrics of a good business are growing along with the top line revenue and the bottom line profit. Now, another factor that may impact valuation is that the business may warrant a higher multiple if it's been operating successfully for a long time. And by a long time, I mean 5 or more years. So showing steady growth over 5 years, or even just consistent profitability over 5 years, it passes a significant hurdle because most businesses or a lot of businesses end up failing or declining after about 5 years. So if when you're evaluating this Flippa listing and evaluating this business, you see that the business has been operating successfully for 5 or more years, that's an added bonus. Now, 5+ years of operation shows that the business is a lower risk for the buyer because it's been operating for longer. So, therefore, the seller is, in most cases, able to charge more. That's just the trade-off that you're making. Now, even older businesses like 10 or more years with consistent profitability may be able to command even a higher multiple. Now, on the other hand, if the multiple is below the 2x to 4x range, you should look for a reason for this as well, right? I wouldn't just go in there assuming that it's mispriced and you're getting a really good deal, right? If the business is underpriced, there's probably a reason. Now, first off, I would check for declining revenues. Often a dying business will be priced at a discount because the owner wants to get out before things get really ugly. Now, if this is the case, there are two sides to the coin. You could be getting a business that's underperforming, that's distressed, and if you come in there with your skill set and you revive the business, you could get a really good high-performing asset at a significantly lower price. That's the plus side. Now, the downside is that you could be trying to catch a falling knife. And now what I mean by that is a declining business is probably going to keep declining unless something else is done. And if you're not confident in your ability to reverse that trend, there's a decent chance that catching a falling knife could mean capital losses for that business and continuing to underperform for that business. So if you are attempting to buy a business that's declining in revenue, I would just make sure that you have a confident plan on how to solve the present issues that are causing the current decline. Another thing that you might want to do if you see a business that's underpriced, that you can't really justify that underpricing based on any revenue trends, is you want to maybe look for problems with founders or teams. Now, often an internal conflict with the team can lead the business to being listed for sale. This may not entirely be evident from the listing, but in the next lesson, we're going to cover some of the things that you can ask the seller during discovery or that first process in learning more about the business to determine the health of the organizational chart and the people that are in the business, founders, teams, etc. Now, if there is a problem with the founder or team, your next job is to determine whether this problem is going to carry over once you own the business. Now, if you're cleaning house and you're planning on getting rid of the entire team, it likely won't be an issue. But if you do plan on keeping the team around for systemization purposes, then you probably want to know about what these issues are and whether or not they're going to be solved once the founder or the owner is removed, or once there's new management, being yourself, in place. Now, there's a few more key metrics on the finance side of things that we're going to want to look at as we're going over and digesting and evaluating this listing. So the first one being profit margin. Now, e-commerce stores have notoriously low profit margins, maybe 10 to 30%, maybe sometimes 50%. The SaaS businesses typically have much higher profit margins. Sometimes even info product businesses, consulting businesses have higher profit margins, maybe 50, 60, even 90% profit margin. So you want to be careful comparing different business types, comparing their profit margins against each other. But at the end of the day, the higher the business's profit margin is, the lower risk that business is going to be to you acquiring the business, right? Because it's going to have less overhead compared to the amount of money that it makes every month. So if you're stuck with a business with high overhead that is barely able to pay for that overhead every month, and you take over and one thing starts to go wrong, it's going to be tough to make payroll every month. It's going to be tough to cover all the expenses of the business every month, especially if you're starting over with a new balance sheet, right? Especially if you're starting with a new bank account that's going to have zero in it, compared to a business with a high profit margin, or I like to call with a lot of fluff, right? There's a lot of room for error in a business with a high profit margin. So the business makes $10,000 a month, but it only costs $1,000 a month to run, well, you're operating on a 90% profit margin. And that's great because the revenue could decline by 90% and you're still not in the red. Well, obviously that's not ideal to have a business decline by 90%, but it's a lot more catastrophic when that revenue decline by 90% is putting you into the red than it is declining near or close to near zero. Monthly expenses is another thing that goes hand in hand here. You want to make sure you understand what exactly the business is spending on every month, right? So it's one thing to say, okay, it costs $5,000 a month to run this business. Well, okay, that's great. It's good information to have, but you really want to make sure you understand what that $5,000 is being spent on, particularly if any of those expenses are not fixed. So a fixed expense is something that's not going to change. The amount that you're spending on this thing is not going to change every month, right? So these include typically employees, unless they're being given raises or bonuses. Employees are fixed expenses, right? So someone makes $60,000 a year. No matter what the business does, you're still going to have to pay this person $60,000 a year. Now, variable expenses take a little bit more digging into. So if you have things like employee revenue shares, right? So employees being entitled to certain percentages of what the business brings in. If you have advertising costs, those are also variable expenses, right? Because you can scale those up and down month to month. So those take a little bit more digging into. So bottom line, the three things that you want to make sure you understand about every expense is number one, how they're broken down. What exactly is each dollar being spent on every month? And this is something that you should be able to verify with the seller before you sign an LOI. What is it? What's being spent every month and on what? Number two, are these expenses fixed or variable? And number three, when you take over this business in order to scale the business or in order to implement your playbook on the business, are there going to need to be further expenses? Now, the next thing that we're going to want to make sure that we understand is the age of the business. Now, this is just going to be a number, right? You're going to have, okay, the business is X years old. You want to dig into this a little bit more, right? Because you can have a 10-year-old business that's been making money for 6 months, right? And that isn't really the same as having a 10-year-old business that's been making money consistently for 10 years. So if the seller is telling you that the business is X years old, you want to verify that by making sure that you see financials as far back as possible. Now, if you can only get back 3 years of financials, you should treat that business as a 3-year-old business because you should only consider a business as old as it has performance history, right? Think about it as if you bought a car in 1990, right? And you didn't drive that car until 2020 and you drove that car for 4 years. And now it's 2024. Technically, that is a 34-year-old car, but it doesn't have the mileage of a 34-year-old car. It has the mileage of a 4-year-old car because it's been performing for 4 years. Now, I realize that might not be the best example because typically with older cars perform worse and older businesses typically perform better, but that's kind of the point that I'm getting at. You want to make sure that you can verify the performance history for as far back as the seller says the business is old. Now, an important thing to note here is that age is stability, right? Especially when it's accompanied by strong financials. You also want to consider the time that the business has taken to reach its current level of performance. Did the company scale really quickly and then plateau, or did it grow steadily over a long period of time? Now, this can often give you an indication as to how scalable the business is post-acquisition. If the business has been plateaued for 10 years, well, there's a lower chance that you're going to be able to extract extra growth out of that business than there would be if the business has been growing by 10% a year for the last 10 years. Well, I'd be more likely to expect that 10% growth per year to continue post-acquisition. Another thing to check here is, has the business faced any significant disruptions in its operational history? Now, in 2024, we're at a very convenient time to buy an online business because we get to see how it performed during COVID. We want to make sure that you see 2020 and 2021 financials if possible, because this can give you good insight as to how the business may react to a future crisis. Now, obviously, we never predict crises, but having that data point can go a long way in giving you more confidence in making that investment. If something performed well before COVID, during COVID, and after COVID, then you have a lot of confidence that that business is going to be resilient going forward. It's worth noting that any other disruptions or spikes or dips in revenue or profit should be accompanied by context from the seller. Now, if you ask and there's an evasive answer, that could be a red flag. Typically, educated sellers are going to know that if you ask a question like that, then they should be providing a clear answer. Otherwise, it's going to be construed as probably worse than it is. So you should be getting clear, concise answers to any operational or performance issues or spikes or dips. If you ask those questions, an educated seller, if they have gone through the seller's boot camp, should know that they should be providing you clear and upfront answers. So you should be wary of any evasive answers you get to questions like that. Another thing that you can do to verify the age of the business is you can use the built-in SEMrush tool within the Flippa listing. Now, this is a really cool thing that Flippa does. They integrate with a company called SEMrush that gives you a full breakdown of the domain age, the domain authority, all the different backlinks. I believe the basic report is free to generate, so it's definitely worth doing that. Just gives you an extra data point. Now, a couple more red flags to look for here is number one, significant revenue fluctuations without any clear explanation, kind of like I just said, but you should probably get justification for revenue spikes as well. You want to make sure that you understand why the business is deviating from its typical performance, right? Even if that performance is elevated. So if you do see a spike in revenue around November, well, that could be a Black Friday sale. And you would just want to know that. Another red flag that you'll want to look out for, and this may or may not be included in the Flippa listing, but if it's not, you should be able to ask for this from the seller, is high dependency on one single product or high dependency on one single customer. So if you're trying to sniff out these dependencies, what you can do is you can ask the seller for a breakdown of sales by product, and you can ask the seller for a breakdown of revenue by customer. They should be able to provide these things for you if the business is well systemized and well tracked. Now, any business that gets more than 20% of its revenue from a single customer should be treated as a little bit higher risk than the other businesses, because if that customer were to walk away, well, there goes 20% of your revenue. Whereas a business that has 1,000 different customers, each paying 0.1% of the total revenue, it's a lot more resilient to invest in a business like that because you have a lot higher chance, or there's a lot higher threshold of chance required for that business to lose a significant portion of its revenue. Same thing with the products. A company that has well-distributed revenue streams over 5 or 6 different products, each taking up between 10 and 20% of the overall revenue, well, that business is going to be a lot safer for you to invest in, because you know if one product goes out of market, or if one product has a copyright strike, or something happens to one of the products or even two of the products, well, you still have a majority of the business, versus a company that relies for all of its revenue on one single product, particularly if that one single product may have any vulnerabilities, such as it being based on a employee that's no longer with the company that may have a claim against the intellectual property, or a product that you feel may go out of business soon, or a product that is maybe a fad or a trend. Companies based around a single vulnerable product should be treated as higher risk. Another really important and cool thing that Flippa does on their listings is they have this comparisons and benchmarking section, which they'll show the exact multiples that similar businesses have sold throughout Flippa's history. Now, Flippa's sold 100,000 businesses in its lifetime, so the data on this is just expansive. But if you look at the comparisons and benchmarking section on Flippa, you should be able to see if the current business you're looking at is an outlier compared to all the other different businesses that have sold in the same niche or the same industry. So now the following thing to verify once you're going through the listing and you're going down the listing and evaluating the business is the social media and the traffic. Now, a business is not a business without traffic. Now, you want to understand where those people, those customers, those leads, you want to understand where they're coming from and what the data behind that traffic is before you engage in an LOI with the seller. Particularly, you want to make sure that you fully understand how the business makes its money, and this all comes down to traffic. The company is really heavily reliant on social media. You'll want to look for the following trends. You want to make sure that there's followers across all channels, right? This is just another dependency risk. A business that gets its leads from multiple different sources of social media, being maybe half from YouTube, a quarter from TikTok, and a quarter from Instagram, is much more resilient and much lower risk than a company that gets all of its leads from just Instagram. Doesn't mean you shouldn't buy a company that gets all its leads from Instagram. It just means that you should understand those risks before proceeding with discussions with the seller. Another thing you want to look out for, bot followers. Now, an Instagram or a TikTok or a YouTube account with followers that don't engage, that's a lot lower value than social media that has really engaged followers. So that's another thing that you'll want to look for. The bottom line here is that you want to verify that social media, if it's used as a significant portion of the business's traffic, you want to verify that the social media is legitimate. You want to make sure the followers are real. You want to make sure that they're posting consistently. You want to make sure that they're posting things that are on brand. Social media is one of the easiest things to do due diligence on because it's exactly that. It's social media. It's all available to you. You don't have to request anything from the seller. You don't have to wonder if they're holding something back or hiding information. It's all out there publicly. So this is a really great first step to take if you're interested in the listing as you're doing your evaluation of the listing. Another really important thing to make sure that you understand about the social media is whether the brand relies on a single personality. Now, this can be tricky, right? You can do a great job investing in a company that relies on a personality. However, you need to make sure, number one, that that personality is staying with the business at least for a little bit while you can get a transition and plan in place. Because any removal of a person on social media runs the risk of having that social media collapse. And if that social media is a significant portion of the business's traffic, then that could pose a significant risk to the business. So again, it's all about just risk tolerance. Another thing to verify here, and this is probably not going to be evident in the listing when you're doing your evaluation, but you want to make sure that you understand if there's an employee on board of the company that is well trained on the social media strategy, and make sure that they're willing to stay with the business post acquisition. So the best, most resilient company's social media is a company that has a full-time social media strategist or even a part-time social media strategist, but someone that's staying with the business that's going to help you get up to date on the social media strategy. Because unlike most things about a digital business, the social media strategy is not something that can be instantly transferred to the new owner, typically. It's going to take time for you to learn about the social media strategy. It's going to take time for you and your team, if you're bringing in a team, to learn how to replicate the style, how to replicate the engagement. Social media is a very nuanced part of digital business, of online business, and you should probably budget a little bit more time and a little bit more buffer and fluff for understanding the social media strategy than you think up front. Now, I could make a whole curriculum on just this, but typically there's two types of social media strategy. On one hand, you have influencer marketing, right? There's a person who makes content that sits behind the camera, like I'm behind the camera right now, that creates the content and causes them to buy the products, right? There's higher upside with this structure if the transition is done well, but there's also higher risk here if the personality decides to leave or becomes unmotivated or even gets hit by a bus. And we call this bus risk. Across the board, it's a good idea to use the rule of thumb that if someone on the team got hit by a bus, obviously we would hope that never happens, but if they decided to quit tomorrow, would the whole thing come unraveled? And if the answer is yes, well, that's a higher risk business than a business that has everything systemized and everything tabulated and everything organized that could be easily taken over by someone else coming into their position. And one of the biggest vulnerabilities in this bust risk could be an influencer marketing centric social media strategy. Now, in a storefront page for social media, the business's social media acts more as a website storefront and is more impersonal. So this is much lower risk, as anyone can come in and hopefully replicate the strategy and the social media strategy. And the strategy does not depend on any specific person. So if when doing your social media evaluation, you see that there's no personality and it's more of a storefront, that's a lot lower risk in terms of your investment. You're also going to want to do qualitative analysis on the authenticity in general of the social media. Does it look like people support this brand? And if the answer is no, then maybe that's part of the alpha that you're bringing to the company. Maybe that's something that you add when you take this business over. Just another variable in the equation to look for. All right, so you can get a lot of good information from the Flip a Listing and the social media before you even contact the seller, right? So remember, this initial evaluation that we're doing, going over in this lesson, all of this is before you even make first contact with the seller. All of this information should be available to you from the Flippa listing, which is tremendous. Now, it really is recommended that each of these evaluation criteria, everything that we went over in this video, is thoroughly explored and considered against your investment thesis before you make any contact with the seller. And if everything checks out, and if at the end of this initial evaluation, you still think this business is interesting to you and you still think that you want to go ahead and pursue this business as an acquisition, then you can make first contact with the seller. Okay, so in the next lesson, we'll talk about your strategy and approach in talking to the seller, in messaging the seller, what you should do navigating if they have a broker, what if you have a broker, including navigating requests for further information. Some parts of this initial evaluation may require further requests for information from the seller, right? So we'll go over how to do that and building a relationship with the seller too in the next video. That's super important, something that's very overlooked, all right? So grab some water, grab a snack, grab a coffee, whatever you need. We're gonna go ahead and get into the next lesson.